guys. Happy Wednesday. Welcome to another week of the Educated Homebuyer Live 2026 edition with Josh and myself. Welcome. We got mortgage rates dipping to 3-year lows. We got activity in refinances picking up. Home buying is picking up. Not a lot of inventory out there right now. Josh, what's happening? New week.
Interesting times. We live in interesting times. The headlines, you're going to see when we get to the chart of where mortgage rates are, headlines are a little bit overblown. Rates are indeed at a 3-year low, but we've got very close to this level a couple different times, and they're marginally better than where they were a couple weeks ago. The hoped for big impact, our episode of the podcast this week that released on Monday was regulatory actions the Trump administration can enact this year. And the big one that we saw last week, we saw two of them. We saw them banning institutional buyers, or wanting to ban institutional buyers, but actually implementing mortgage-backed security purchases. And we saw a nice jump Friday, kind of gave some of it back Monday. We're still right there, kind of at the best levels. A lot of analysis. I'm sure you've seen the same thing, Jeb. 4 or 5 different articles of different experts with different opinions on what, if any, lasting impact this will have.
Yeah, and you've locked a couple of rate loans in the 5, so that's positive. Spreads have improved, which we'll take a look at. So there's a lot of positives happening out there in that world, but unfortunately it's the time of the year where inventory hasn't yet really picked up, right? We're still coming out of those lulls of the holiday season, and therefore inventory is compressed to some degree. We don't really see that start to pick up until mid-February, late February into March, and we start to get that spring buying season. So I know there's a lot of buyers out there ready to pull the trigger, just not seeing those opportunities, not seeing those properties. So now is a good time to start that pre-approval process, get your ducks in a row, if you will. But
was it the NAR figure that came out today, Jeb? This said 1.18 million active inventory, which is almost identical to 1 year ago, which, as you well know, the bulk of the middle of last year, we were well above the prior year pace. So we're back in interesting times. We're going to see what happens throughout the rest of the year.
Yeah. And as that, if you're new here, we always start the show by going over some charts, talking about what's happening in the economy. We like to look at supply. We like to look at demand, like to look at mortgage rates, and we're going to talk about those in general. And then we like to get to answering your questions. So now's a good time, if you have questions, to start putting them in. That way, as we come out of this, we can start answering your questions rapid fire, because that's what we do. We're also streaming on Instagram as well. So if you're on Instagram, you can put a question there. I look at it occasionally, and we'll get to your question, and that's recorded and posted on my channel. So you can always go back and check it out there if you missed the answer to your question. But with that said, let us know where you're watching from, and also, what you're thinking about the housing market in 2026. Better market than 2025 or worse market than 2025? Let us know in the comments. But with that, Josh, let's transition into some charts and move on, as we typically do. So the one thing we like to start with is inventory. And, this chart's a little skewed just because of how the weeks fell compared to previous years. But we always kind of see the year start with a drop. And it doesn't always look as dramatic as this year just because of how that worked out. But we went from 720,000 homes nationwide to 686,000. Last year, we were sitting at
You're
were going to jump in?
Oh, no. You went silent on
Dude,
me.
it's crazy. Like StreamYard keeps muting me. I have no idea. Maybe it doesn't like what I'm saying. How long was I talking without being muted?
10, 15 seconds. First, your wife mutes you, and now StreamYard has.
Imagine that, dude. It's crazy. Not touching anything here, and it gets muted. But nevertheless, what I was saying is just inventory is 10% above where it was this time last year. But again, it's early in the year, not much to really write home about at this time. Orange County, Huntington Beach saw considerable increases compared to last week. Orange County now at 2,976 homes. That's a 6.42% increase week over week. Huntington Beach saw an almost 11.5% increase up to 192 homes. And you can kind of see Huntington Beach is basically following the graph of last year, kind of in the same pattern, if you will. Orange County, we're above those numbers from where we started last year. So both positive signs for inventory out there and that world, because again, as a buyer out there, you definitely want to see more property. This is just a look at active inventory, 7-day average, and this just has, again, more years on the chart, just kind of going back just to see where we were compared to different times, below where we were prior to the pandemic, in those crazy years. But you can see where we are compared to, kind of middle of the road, if you will, sitting between pre-COVID and post-COVID, with regard to the number of homes on the market. New listings, what do we see with new listings? Sitting at
76,270.
There you go. No, that's not what I was looking for. I was looking for, there we go, sitting at 39,000, just over 39,000 new listings coming to the market week over week. Last year, this time, we were having 44,000 new listings coming to the market. So a little bit less inventory coming to the market than this time last year. Again, early in the year, not really much to worry about there. Looking at home sales up 256,000 versus 252,000 last year. So sales are a little bit higher. Again, I expect that number to continue to grow over last year because, again, interest rates last year, this time sitting over 7%. This year, we're scratching the surface at 6, just below 6. So noticeable improvement over last year, which in my opinion is going to lead to more volume when it comes to home sales. How about price reduction? So properties with price reduction sitting at 34.7% last year. This time sitting at 34%. So pretty much lock in step with that. If interest rates continue to stay low and come down, probably going to see that price reduction move sideways to down. If interest rates start to move back up, more properties come on the market, then that's when you see that number continue to grow. Now, started the show by talking about, checking a look at the spread. That is really that comment by Trump last week with regard to buying $200 billion in mortgage-backed securities, Fannie and Freddie doing that and having the cash to do it. The biggest improvement we saw wasn't really in the rate so much as it was, or in the 10-year so much as it was in the spread itself. We saw that spread go sub 2%, Josh, which we haven't seen in, hell, I don't know, 2021, maybe 2022.
Yeah, 2022, and we'll take a look here. We normally look at the 10-year chart only, but because of that reason, I threw in the MBS chart also, just so you can see the divergence here recently.
Yeah, but I mean, if that continues to improve, the 10-year can stay the same, and rates again can continue to improve. But what we'd like to see is that 10-year also improve, which would obviously lead to the lower end of the range that we were forecasting for 2026. So. Home price forecast this was put together by Resi Club. Again, just took a synopsis of everybody out there in the market that had somewhat of a forecast and compiled them together. Reputable companies that had
a reputable plus one.
Yeah, Josh and I weren't on there. It just so you know.
We were not on there, but it's reputable plus one outlier that has no business with actual economists.
There you go. So with that said, Josh, can you hear me? Am I on?
Yeah.
There? Yeah. I think the average, Josh, was 1.8%, 1.43% is what the forecast is for 2026. So the lower end of that range, essentially right in line with what Josh and I were talking about at the beginning of the year, basically flat to 2 to 3%. Assuming rates don't go a lot lower than we thought they would. If rates go a lot lower, then I think that number jumps a little bit, but either way, I think it's probably on the positive side just because of the direction that rates have already taken for 2026.
When I look at that chart, Jeb, the top one is Cotality. Was Cotality? What did they use?
They weren't the top. They were like 3 or 4 down, weren't they? Oh no, were they top?
It's the top, and they're 4 something. Wells Fargo 3 something. So there's some real economists there, not just trade groups that are at the high number. And I just don't see it unless we get interest rates even better than what we're expecting for this year, but likely to be positive, and that is good moderation. We need moderation in home prices. We don't need 3.5%, 4.5%, 5% home price appreciation nationwide for the foreseeable future. So, Jeb, we got a couple of chunks of data here since we were here last Wednesday. Jobs report, you can see it's at least positive. What was it? 40,000 something jobs created, in line with expectations. I think it was either slightly better or slightly worse. But probably the really important thing you want to look at is whether we go back 3 years from 2023 and see a downtrend, pretty consistent, some noise throughout there, but a downtrend, or if we look back just over the last year, you can see a decelerating economy in terms of job creation. And when we look at it in the unemployment rate, we can see it much more clearly. That number, I mean, that looks dramatic, right? Where it's just terrible that unemployment is skyrocketing. You shouldn't really pitch it that way. We were at 4.5 last month, 4.3 this month due to some changes in labor force participation. But when we look at those numbers, those are still really low numbers. So you could see unemployment spike another 1%, and it still would be a historically low number, and it would be a sign of a cooling economy, but not a sign of a crashing economy. So we also got CPI this week. So CPI was 0.3 on a month over month. And on the next one here, we've got 2.7. So consistent at 2.7 over the last 2 months. And we're still in this noisy period, Jeb. We had what, 1 month? You can see where there's no data on the core. It's funny, on the core it shows 2 months there with no data. So on a core was a little bit better this month at 0.2 and then 2.6. So these numbers are much better year over year. We need to take these with a grain of salt, just because with the government shutdown, we had 2 months of missing data, incomplete data. Let's get through the first quarter. It'll be interesting to see what January looks like. We've seen some January surprises where these numbers have spiked over the last few years. So I think the markets, the reason why we haven't seen a lot of reaction to what was otherwise good data moving in the right direction is the markets are taking us all with a grain of salt there. These is the Cleveland Fed's nowcast. And if you look at these numbers, they're predicting for next month 0.12 on CPI, 0.22 on core CPI. So 0.12, we need to be below like 0.16 to be under 2% on an annualized basis. They're projecting January is going to be there. That would be really good because, as I said, we've got some surprises the last few Januaries. Core at 0.22, not quite as good. Same story of what they're expecting with PCE. But all of these numbers would be, other than core PCE, they're expecting by the end of January to be under 2.5. Still not where anyone wants them. We want them to be in that 2% or even slightly below 2% range, but we're absolutely moderating and moving in the right direction, which is proving that thesis correct that most experts had last year, that the tariffs will be inflationary in the short run, but it'll be a one-time price correction and not a long-term change in the trajectory. We always like to show trueflation. This has been below 2% here for a period. Over the long haul, there is a high correlation to CPI. So as long as we see this number staying down here, should be a good sign for what's to come over the next few months. This one, Jeb, I wanted to throw in here because I feel like a little bit that the administration is working at cross odds, and I don't know that they even fully understand that they are doing that. So this was an article hit the Wall Street Journal today from Greg Ip. Says Trump wants to run the economy hot, and there's a good chance he'll succeed. You say, why? Why would he want to run the economy hot other than everyone wants a good economy, right? Well, one of the greatest predictors of re-election and your party holding the seats that they have is how well the economy is doing. So they're working at that. And as you can see, the chart below there is the Atlanta Fed GDP now estimate. So this moderates over the course of the quarter, but it's up over 5% now. The blue chip consensus is still down around 1%, but we were up near, was it near or over 3% in the fourth quarter, Jeb? So
I think it was over 4, wasn't it?
It's a big number. It's a big number. So
yeah.
There's ways to dismiss it and say, well, all of that is investment in data centers for AI. This isn't really dispersed throughout the economy and impacting everyone. So that's why we're not feeling this hot economy. But some of the things that he's wanting to push interest rates lower, threatening to sue, or actually suing the Fed president. And these things, if you were able to artificially push rates down, and we already have a GDP at a higher level, it's going to make that economy run hot and inflation will not come down. So it's like you have all of these things that any sitting president, so take the label off of who he is and say any sitting president would like: reasonable inflation, a bunch of jobs, good, but sort of Goldilocks, good, but not too good of GDP, because then that's going to lead to higher inflation, higher interest rates. And I think they're trying to pursue everything all at once, which is a pretty hard objective to meet. So we'll be here every
And I
week.
did
We'll
look
go
back. It
through
was just over 3%.
Okay, so just over.
Yeah,
So
yeah.
you and I will be here every week going through it and see how they do at meeting all of those objectives. But definitely something to keep a look at. So this here is the weekly candle, Jeb, for the 10-year going back to like the middle of last year. So you can see that yellow line, yellow arrow I drew in there. It's pretty consistently down for the better part of the late summer and early fall, and then we've just been going sideways, pretty much sideways between the number here between 4 and 4.2 going on the better part of 3 months. So we're in that range that we've shown and defined by the upper and lower green lines there over the last few months. But this is that same sort of sideways trend with the two blue lines there of what was happening with mortgage-backed securities. Mortgage-backed securities, these are prices, not rates. So you want the price to go higher because that means that rates are coming down. And we did see over the last 2 weeks, end of last week, and so far this week, it's holding that up and out of that range. So that's where you're seeing the spreads, the spread between mortgage rates and Treasury yields narrow. What we want to see is Treasuries participate also and get those yields down under 4%. And you could see where all conventional rates would have a 5 handle on them versus a lot of borrowers with lower down payments, lower credit scores are still in the low 6s currently. So in looking at that, here's the chart there, and I circled again the green box there because what I wanted to point out is we're 1/8% better than last week in interest rate, 0.12%, basically exactly 0.125. So the headlines are screaming rates are at 3-year lows. People get super excited and they expect to hear that their rate is going to be ultra low. It's better than last week. So it's 0.25% better than a month ago, 1.18% better than a year ago. And if we have thrown the chart in here on mortgage applications, especially refinances, they are through the roof year over year. Historically, they're not huge numbers, but massive compared to where we were last year.
I think it's up like 40%.
Yeah, because we're up, we're down over 1% in interest rates. And that's what we've always said. If rates cooperate and moderate to a level that people can tolerate, it's definitely going to put a solid floor under the market. I don't think it's going to be, the match to the gasoline that some people fear that it's going to shoot prices to the moon, but it definitely gives us a floor on volume and makes things better for realtors and people in the mortgage business because you have sort of this stability and you don't want to call it Goldilocks or middle ground because for most people it's still too high. But this is much better than where we were a year ago.
All right. So with that said, if you are thinking of buying in 2026, now is a good time to do our workshop. It's going to be on January 27th at 5:30 p.m. It lasts about 90 minutes. We've done this, did it 3 times last year, Josh, 2 in the spring, 1 in the fall, put 7 people through it. Actually put hundreds of people through it, but 7 people actually bought houses that attended it. 1 is under contract right now from the December one. So again, it's a good way to understand the process. Doesn't cost you any money. It's it's free. It's just education. It's a lot like this, but just in a more formatted way to just take you through what home buying actually looks like. So if you're interested, the educatedhomebuyer.com/workshop will get you to the link where you can register, and you'll get some reminders. And on that day, we will be doing it live in front of you guys and answering your questions at the end. So if you're interested, make sure you check it out. All right, Josh. Well, I think also while we're doing this, probably important to mention this. If you have an interest rate right now, you're considering refinancing, you're just waiting to see what rates are, or if you qualify or looking for a certain rate. If you scan that QR code or go to jebsmith.net/rate watch, you can get on our list, and Josh and the team will reach out to you if and when rates hit whatever that's that number you're looking for is. And
right now, Jeb, rates are so good that we're going to reach out. We'll give you a call. We'll go through it, give you a comparison of what it looks like, and we'll set a strike rate. Say, hey, when rates hit here, we're ready to go. So there's really no guessing. We're just monitoring and ready to go once you hit that level.
All right. So this is the point in the show where we start answering your questions. If you have them, make sure you put them in now. Kind of not necessarily in order, but kind of try to show some love. And the people that were early in here, we try to get into those and then just go down the list. So we got a lot of people hoping for lower rates, which I completely understand. And just reading some stuff as we put it out. So we got Pastor James Andrews says, we have a new property manager taking over for our entire short-term vacation rental community. what records would you make sure to get from the old property management company before the transfer? So I would think that most of that information will be transferred to the new property management company for the most part. If it's a short-term rental, I would try to get a list of all the people that rented that property from you. If you have that information, names, email addresses, phone numbers, what they paid during that period of time, what weeks they were there. Josh had a short-term rental in the desert for a number of years and literally was the same guy renting it for the same period of time, year after year after year. And so at some point when you have that information, not that you can necessarily go outside the property management company, but you might be able to go outside the property management company and save some bucks there, if at all possible. I don't know.
And depending on the type of financing you're doing, if in the future you need to finance and you need to show that history, if you're looking at a normal loan, full doc, you're going to provide the tax returns. The tax returns are going to show how much money you brought in. But if you're looking for some type of alternative documentation where we're just using the rental history, it can be really good to show how long you've had it, what the trends look like over the long haul. So really just a spreadsheet of the bookings and what you've had and what they've paid.
All right, good stuff. Let's see here. We got Dixieland watching from Minnesota, as we always do. Question here from Eric. It looks like if you are a first-time home buyer in the Atlanta area, how would you react to the news of institutional buyers? So if for those of you who don't know, institutional buyers, what we think they're referring to as institutional buyers, because there was no exact definition giving, is those that own more than 1,000 properties nationwide. And if you look at them as a whole, depending on what data you follow, somewhere between 1% to 2% nationwide is what they own. They don't own 50% of the real estate nationwide. They own 1% to 2%. The problem is it's highly concentrated in a couple of markets. One of those markets is Atlanta. So what would my thought be on institutional buying? It could be a positive for you as a potential buyer going into that market, because now you got less competition potentially, depending on how much they bought over the last couple of years. I believe the last couple of years, there's been a lot less of that buying just because of where prices and rates have gone. But as long as they aren't forced to sell the current inventory, which I can't imagine that's going to be part of this, then I don't see any reason why your plan would differ. If in which case part of that plan is, hey, institutional buyers have to sell some of this stuff, then that would mean a flood of inventory on the market and could, completely compress prices to the downside. So that would be a negative. I don't think that's going to happen. If I were a home buyer looking in the market, to be completely honest, it probably wouldn't impact me one way or the other. It would either be, hey, is this the right time for me to buy or is it not?
No reference in anything that I've seen from the administration has been made to forced selling. We're going to not allow them to buy. So if they don't have to sell, it doesn't change anything. It will change things over time because some of those institutional investors will obviously choose to sell and divest some of those properties over the long haul. But in the short run, you're 100% correct that it doesn't move the needle. It doesn't make a difference. And we go back to all of these policy proposals. We're more likely trying to win the press conference than we are to win the war. 60 days ago, we were talking about 50-year mortgages, and today they're saying, yeah, we've moved on. They like floating these trial balloons out there, seeing how the public reacts and what they think. And this one it's politically viable because it sounds really good. And anyone that doesn't own a home, especially if you're in Atlanta, if you're in Phoenix, if you're in some of these markets in the Southeast, it sounds great to you, right? It's less competition for me to buy a home. It's not a big factor in the market nationwide. So there's few people that are impacted, and there are unintended consequences to locking out those participants from those markets in the short run, even for people looking to buy.
Good stuff. Somebody's saying, hey, if they have an interest rate right now, just say 7%, Josh, 6.99, should that person take advantage of the current rates that are out there in the market, or should they wait and refinance, hoping for lower rates?
Unless you have a really tiny loan or bad credit, a 6.99 rate should be refinanced. So we always go back probably about the 10 millionth time. We should keep a little tally. We should ring a bell, Jeb, when we talk about the rule of thumb. Take 125,000 divided by your loan amount. So let's say you have a $250,000 loan. 125 divided by 250, it tells us 0.5%. And the 0.5% doesn't mean guarantees we should do it. 0.5% is the 125 divided by your loan amount is a really good rule of thumb for a no-cost loan, which means you're taking a slightly above market interest rate to get a credit from the lender to cover all your costs. At that point, it is a no-brainer. So where you're at, what the closing costs look like, what your credit scores look like, how big the loan, all those things are going to go into it. So it's always interesting. One of the other questions that we have here, Jeb, Tracy says, I missed it. How low did the rates drop to? I want to see if it makes sense to refinance yet. You cannot watch headlines, the news, even CNBC is going to report either a Mortgage News Daily number. They're going to report the Freddie Mac weekly primary mortgage market survey number. Those numbers don't apply to you. I talk to people all day, every day, asking for the same loan, a conventional Fannie Mae Freddie Mac loan. Your credit score, your location, your property type, the property use, the loan to value, all of those things are going to come into play. And even though we look here in Mortgage News Daily's reporting 6.07, I quoted people above that today, and I quoted multiple people well below that today. It depends on you. You need to talk to a professional, someone with access to rates from multiple sources who can run through and ask you all the questions needed to get you accurate numbers.
All right. Good stuff. Let's see.
If we weren't clear, Jeb, we can do that for you. So use the link below and reach out. Happy to go through it. I mean, sometimes the answer is no, but even if the answer is no, it doesn't make sense today, we go, where does it make sense? And we mark that line in the sand. And if and when we hit it, we reach out.
Absolutely. Absolutely. Let's see here. Any more questions that are on the table at the moment, Mr. Lewis? I don't see any right here. Just
I see a comment from Drew Vogel, who has not commented in a long time. But good evening, gentlemen. This is the year. Drew, this is the year that you buy a home. This is a year that you buy 20 homes. This is a year that you take on world domination. What is this year all about?
There you go. Let us know. This comment is from Jasmine, located in Michigan. Do you know about MSHDA, and what do you think about it? Are you familiar?
I will hit a little Google on it. We get a lot of questions about a lot of programs.
It might be if it's a specific program that's in Michigan or in your area, then it's probably some sort of, let's see here, down payment assistance program. Josh, is it?
Most likely. So vouchers, buy a home buyers. So while we're going through everything, I can dig up some. So a Michigan $10,000 down payment assistance loan. They run the mortgage credit certificate. They have the Michigan home loan mortgage. The majority of these programs that are bond subsidized programs around the country look a lot like Cal HFA for us here in California. So it's in the form of a second and or a third subordinate mortgage that goes against your property. Sometimes they're forgiven over time. Most of them are not. They come with a higher than market interest rate on the first. So you have a higher interest rate, you have a second and or a third that generally doesn't have a payment and oftentimes doesn't have any interest. So you hear that, no payment, no interest. Cool, put an extra lien on my home. But we have probably 6 or 7 people, Jeb, in line right now who the numbers, when we run their refinance numbers, absolutely make sense. But one of the programs in Florida, the program here in California, if you have one of those subordinate liens, they will not allow you to refinance without paying them off. So if your home hasn't gone up in value enough to pay them off, or you don't have the cash to pay them off, so you're stuck in that loan. So all of these people are 7% or above and could be at least 1% lower and don't have the ability to do anything.
There you go. Sorry, I was preoccupied here. I was selecting my flag football team name because, it gets competitive out there, Josh, and you need to make sure you get your team name. So
what were you hoping to have dibs on? What was the name you were going for?
Well, we're in this, we're doing, we're professional teams right now. So we went Panthers because Carolina Panthers fan. So we want the Panthers. We've been them the last 2-3 seasons. So and I already have the gear. So we don't want to buy gear for teams that we aren't affiliated with, which I've done that plenty of times. We've essentially been every team. So I started getting smart and going with the same team. And then when we go into college, which will be next year, we'll go for the Pirates, baby.
I like it. I like it.
We got to stay true to the teams.
Do you get to pick your colors? Are you not just the Pirates? Do you get to be the purple and gold Pirates?
Well, it's all done through. It's all collegiately represented, so it's all done. Yeah.
I like it.
You got all the stuff. All the colors are accurate, just like the Panthers are. I mean, the jerseys aren't as cool, but it all works out. All right. Let's see here. We have some. Here's a question. I read these guys as I post them a lot of times. So sometimes I might think it's a question and it could be a comment, but let's see. Yield curve control. Could this be used in conjunction with the new low rates, Federal Reserve chairman coming in with all of the global reshuffling? So yield curve control, essentially that's what's happening at the moment. That's how they're bringing rates down, right? Trump wanted lower rates. In his eyes, he couldn't get Powell to do it because he thought that was the trigger. So he's doing something that truly is going to lower rates, or actually did lower rates, and that is have Fannie and Freddie buy mortgage-backed securities, and in turn, it compressed that spread and allowed mortgage rates to come down. Now, the new federal Fed chair can't really compress the spread so much. I mean, can they decide to buy more mortgage-backed securities? I guess they could, but there's not really a reason for it at the moment. So I don't see that being part of the new agenda, but what do I know?
So, Jeb, yield curve control is like quantitative easing on steroids. QE, they say, we're going to apply this much money to buying mortgage bonds, and that will bring yields down. So is it yield control? It is. But with yield curve control, it's what Japan did for a number of years. They say, we will spend any amount of money to defend this yield on our treasuries, or U.S. treasuries in this case. I truly don't think it would happen, but obviously it's been done. It was done in Japan for 20, 25 years. So it could happen. Don't believe it's going to happen. Have a follow-up here with the wars or operations happening. Could yield curve control be used and justified like it was from 1940? Yes. Can it be done? It can, but everything is politicized. Everything is a war. And not literally a war, is a battle inside between two parties who are committed to doing nothing and blaming the other for it. That's my political statement for the night.
There you go. Got Jeremy coming on, getting ready to sell 2 houses to get VA entitlement and under contract on the next one. It's also going to be a fun spring. Cheers from Indiana, gents. So appreciate you watching. Josh, why don't you talk a minute here about VA entitlement and how that works? I know a lot of people here aren't VA, but there are some probably watching, and I think it's important to kind of explain what we're discussing.
So the fun part is, if you get your certificate of eligibility, you're a veteran, you get your certificate of eligibility, and say $36,000 of entitlement if you've never used it before. And in general, there's a 25% guarantee. So 1/4 of the loan size, you could get a $144,000 loan. That's not how it works. They will guarantee up to 25% of any loan amount if it's your first time use, or if you have full entitlement. Buy a $5 million property. A friend of ours, Jeb, down the way, is doing a VA IRRRL for a veteran with a $6 million loan. So there is no loan limit. Most lenders have a limit. There's only a couple of investors that will do those giant ones. But the entitlement there, you can buy multiple properties. So in Indiana, if you buy a $100,000 home and you finance it 100%, that's only going to use a tiny bit of your entitlement. So you can have bonus entitlement or secondary entitlement and buy second and third and fourth property. I have a friend in Texas. He is a veteran. He specializes in helping veterans with their mortgages. He has a client who, as he was PCS'd around the country, sent to lower cost of living areas every time. I believe it was either 4 or 5 properties he acquired, 0 down, with just his bonus entitlement. So you get to a point where you run out of entitlement, you can't buy another home. And the way you restore that, you can do it one time by refinancing the loan and paying it off. But the best way is a permanent restoration by selling the home.
Got it. So I had somebody ask me a question, Josh, the other day, and I truly didn't know the answer to it. So let's ask you. Said I thought what I knew the answer to be, but let's see if it's verified. So say, for example, you assume somebody's VA loan, and when you assume somebody's VA loan, essentially they can't restore that entitlement because now the loan's been assumed by someone else, right? So at which point that person who assumed that VA loan either refinances that loan out of VA, which I don't know why they would do that, or they sell that property and that VA loan is no longer encumbered on that property. Is the entitlement then restored back to the original veteran, even though that veteran didn't sell
Yeah.
that property? It is.
It's their
Right?
entitlement. So their
Okay.
entitlement is held up
Sure.
by that loan. So when that loan is paid off, then it will be restored. There is an option. You're generally talking about a non-veteran assuming a VA loan.
Correct.
If another veteran assumes it, they can substitute their entitlement and restore yours so you can move on. And those are probably the most common assumptions is veterans PCSing from one duty station to another, that they've built up some equity. They're selling a home here. They have the equity to buy. And then, so career military people wanting to be near a base and helping each other out by keeping these loans in play at lower interest rates.
There you go. Good stuff. We got Israel says, my question is, when I apply for a first-time homebuyer loan, can they run my pay stubs and run my
wife's
credit?
His wife.
Oh, my wife's credit, because my credit is bad, but I make over $100,000 a year. So Josh, when you apply for a loan, how does income and credit work if there's more than one person?
So there are some unique scenarios that are outside of this, but any major loan, which 99% of you are thinking here, FHA, VA, USDA, Fannie, Freddie, they are all going to take all borrowers on the loan. They're going to run everyone's credit. They're going to take the middle score. Then they're going to line them all up and then say, who has the worst? So you could make $1 billion a year. If someone else on that loan has a 200 credit score, we're using the 200 credit score. We don't get to pick and choose who has the good elements.
So Josh, go back and talk about the middle score. Because when you say that, some people think the middle score of what? Like, is it an average? Is it the median? Is it like the middle score? But understand, like, explain, because there's, got more than one credit score.
The median or mid score of all three bureaus. And we have to pull currently all three bureaus. Some of the proposals out there are to go to one or two bureaus. And the reason for that is each one of those bureaus costs money. Jeb, I saw a new lender today who, without going into details, they're going to be charging $225 for credit reports. And that's not a crazy number. That's a real number that they're paying for credit reports. And a few years ago, pre-COVID, that was $30 to $50, depending on how many borrowers and all that. So we have to pull all three under current guidelines. If one is frozen, we got to get it unfrozen because they think you're trying to hide something. If you only have two scores and the third one isn't there, they're going to take the lower of two. But we have to legitimately not have a third score. We can't just go, I don't like that one, I'm going to freeze it and not show it to you. We can't pull two and pick the low. It has to be one that's frozen. So you have three different credit bureaus: Experian, TransUnion, Equifax. They all maintain files on you. They all run the FICO model on that data, but they have different data. So it's not that it's different models that they're running on your credit. It's that there's different data in each one of those bureaus. So that's what we're talking about with the mid or median score for all borrowers, and then the lowest of all of those. There are some home equity lines of credit that will take primary wage earner. There's some non-QM loans. I think I've seen a few jumbo lenders that will use primary wage earner, but for the most part, so in his situation, especially if you are the primary wage earner, there's no world that anyone's going to go, hey, your wife has good credit. You make all the money, but your wife actually pays her bills on time. She didn't help you by paying your own, but she did pay hers.
All right. This is because we have some first-time home buyers in there that I've seen. I'm going to mention this again. We are doing a live workshop on January 27th at 5 p.m. Pacific Standard Time. It'll last about 90 minutes or so, where we go through the entire home buying process, what that looks like, from pre-approval to buying the home to getting the keys. Really A to Z and A to Z walkthrough on that. There's no cost. You'll leave with some incentives. And more importantly, you'll have a playback there to watch multiple times if you want. This is not posted on YouTube. It's not on the podcast. Literally, it's just there for those who want to become more educated. And we'll take you through that process. So theeducatedhomebuyer.com/workshop will get you in touch with us. I think there's 25 or so people registered right now, Josh, last time I looked. And we got a couple more weeks, but get in early. You'll get some reminders, but more importantly, you'll get educated through that process. All right. Josh, we got somebody in Statesville, North Carolina. I know somebody from
How close to
Statesville,
Kinston is that?
It's Statesville's closer to Raleigh area. But I'm east of that. I'm well east of that. But I know somebody from Statesville. I went to college with them. But anyhow, currently conventional loan at 7.5%. How much of a rate drop does it make? Does it need to happen to make it make sense, Josh? Should you wait for later? What's the formula you use? Let's hear it.
125,000. Where's the bell? The ticker didn't go off when we said it again, Jeb. 125,000 divided by your loan amount will give you an idea of where it makes sense to have a conversation with a loan officer.
Give us an example.
If you have a $500,000 loan, 125 divided by 500 tells you need just 0.25% savings for a no-cost loan. Most people want to see more than that. So let's say you have a $250,000 loan, 125.
Let's do this. Why don't you tell us your loan amount? Tell us your loan amount right now, and we'll tell you how much you're going to save. How's that?
I like that idea.
That's even better.
His screen name doesn't give away who they are or where they're at. A credit score would be helpful also. Here's the things as a lender that we're primarily looking at that are going to dictate your interest rate. Credit score, loan to value. If it's a condo and it's over 75%, that can come into play. But basically, loan to value and credit score are the big things we're looking at.
No,
so
that's not right.
Yeah, it's 120,000. Oh, Sean Gilchrist comes in and comes up with his own number.
Unless Sean is
Mav Angel is on the other side of the couch and Sean answered for the two of them.
Yeah, I don't know. Let's see. Is Sean Mav Angel the same person?
Just take that number. If you have a $120,000 loan, literally you need 1% savings. But at that 7.5%, even a $120,000 loan, you need to be having the conversation. It's a little more difficult and it's going to be an individual conversation. Could someone with a 7.5% rate and a $120,000 loan go, no, that I'm looking at the numbers and that's not worth it if I could get it to 6.25? They might. Sure. They might say, hey, I'm moving in 3 years. Why would I pay $3,500, $4,000 in closing costs to save, $75 a month? So that's the big difference is you need a much bigger move in interest rate on these little loans to make it make sense for you.
Yeah. And today on the podcast, we actually filmed next week's episode that'll drop on Monday. And we talk about the costs that are involved in refinancing, in buying a home. How much money do you need? We actually go through that from everything from earnest money deposit to home inspection, appraisal, down to closing costs. So Monday, 5 a.m. Pacific Standard Time, that'll drop. So if you're interested in all the costs involved, it's a good episode to check out. So Mav says, I'm at $208,000 at the moment. Credit score 720. Wife also.
So that's important. That's important, right? We need both of them at 720. So we got a good credit score, 208,000. So if we use that rule, 125 divided by 208, it's a little less than 250. So you probably need a 0.6% savings. So we get you like 6.9. You should be with that 720 credit score safely under 6.5. So we have a full percent savings there. Should be able to keep the costs minimized there. Depending on the loan to value, you might get an appraisal waiver, some other things. So that's really what you want to look at. You want to look at the recoup period. So cool. How low can I get my interest rate? What is my monthly savings? And how long does it take me to recoup the cost of that loan? And am I going to be here long enough? Am I going to sell the home? Am I going to do something else? Those are the big things. And we also want to look at, if these smaller loans, if you've been in that for 5 or 6 years, a lot of the savings from the loan is stretching that back out to 30 years. We want to at least have the conversation of saying, do we want to look at a 25-year? Do we want to look at a 20-year? Do we want to shorten that up so that you're not giving up the years you've already paid into it? And your plan with that home, I have people that rationally make the decision, no, I want to go back to a 30 because that will keep my credit score as low as possible, or it'll keep my payment as low as possible because I'm only going to be here for 2 years. So whether I do a 25-year loan or a 30-year loan, my balance when I move out of here is going to be pretty similar. So those are the things that you want to be having that conversation with your mortgage professional, which we would like to be if you would like to run through these numbers.
Yeah, use that link in the bottom of the description there. But yeah, I mean, you could go the other way. You could keep your payment the same and just shorten the loan term. I mean, that's an option too. If you want to pay that thing off faster. So talk to a mortgage pro and have them, give you some options.
You will find this almost impossible to believe, Jeb, but I have a pretty wealthy borrower, listener to the show here, with a $990,000 loan. We can save him 1% on the rate. He's a busy man. He's like, I just don't have the time to pull this stuff together. And when we look at it, like sometimes when you say, hey, we got $800 of monthly savings, you're like, yeah, I like
save about $1,000 a month.
It's going to save a lot of money.
Yeah.
But I ran the numbers. We can take it down to a 20-year and keep the payment the same. So it's like, okay, we're giving you a 9-year time machine in terms of paying your home off and rapidly paying down the loan. Are you getting a call from a borrower, Jeb? I just got a call from a mutual client of ours.
No, he texted me and said that he meant to call you. So
he did call me. He didn't know that we're talking on the internet right now.
Okay. No, all good. But yeah, okay, good stuff. All right, guys, it's that point in the show. If you have questions, now is a good time to throw them in. If you're watching on Instagram, you can throw your questions in there as well. 70 something of you watching at the moment. So I know there's some questions out there. And also, if you found any value, make sure you hit the thumbs up. If you're not subscribed, what are you doing here? Make sure you subscribe to the channel.
This isn't a direct question, but I think there is a question here. Arnold says, I got a loan last year for 6.6, and today I got quoted 6.5 for a refinance with a 780 credit score. Give us a call. Just give us a call.
What's your loan amount?
Use the
condo,
link
single family.
Yeah, unless it's a tiny loan or a really high loan to value on a condo. Like, it just doesn't sound right. I haven't quoted anyone that high in 2-3 months, much less in the last week. Someone with a 780 credit score, someone with a 680, 650 credit score, maybe, but that 780 score, you should be looking at a much lower interest rate.
Agreed. Josh, let's see here. I know you started the show. There was less people in there at the time. We were talking about rates. Give us an example of some rates that you've recently quoted on purchases and refinances. Fives, how low in the fives have we seen?
So we've shown the charts here before. The average buyer right now has a really high credit score. So I would say most people buying are above 740, probably 80% above 700. Those below 700 are looking at FHA. So the FHA stuff, I'm looking right here at the chart we show up at the top of the show from Mortgage News Daily. They're showing 6.07 for a 30-year fixed conventional, and FHA and VA right at 5.75. Should be a little better than that for both. So those borrowers, when they quote those numbers, it's 25% down or 25% equity and 780 credit score on the conventional. People in those ranges, most of the stuff that we're looking at is right at 6 or under 6. Again, some of this comes down to your loan size as well as your credit score, but most of the people we're talking to, even if it's 5.99, psychologically, that's an important thing. People it makes them happier to see a 5 at the beginning of their rate than 6.
How long do you need to wait to refinance a VA loan? Is it 210 days, Josh? 210?
It's 210 from closing. You have to have made 6 payments, and 210 from the first.
There you go, Jeremy. That should answer your question there. So 210 days after closing, you should be able to pull that trigger. Let's see. Single family original purchase price $1 million. New refinance price will be $720. Since I have 20% down payment and paid additional principal. So they originally purchased it. $800,000 was the loan. They paid down additional principal. So now they have a balance of $720. I'm not sure what they're asking here, Josh. They're
just following up with the details there. 6.5 is insane.
Oh, I got you.
It's Arnold, same guy. So the person quoting you 6.5% is a thief. Let's just say that they're either a thief or incompetent. Those are the two options. But I'll say this: we had a listener reach out that I talked to him last year. Rates weren't quite there. Well, he got a quote from his current lender, and so we hear who the current lender is. And there's 3 to 5 different lenders that you just know. I say, well, did you get that? Did you get lube with the offer? Because that's what they're going to be offering you. So the rate sounded great. And then we're going to waive the origination fee, and it'll only be 1 3/4 points. It's a 0-point rate. Like, what do you mean? There's no origination fee. Or like, I had that from a listener this week. Well, it's 0 points. I didn't get any points, but there's a 1% origination fee. Like, disabuse yourself of this notion that there are certain things that are different from other things. If it's origination, discount, anything of that sort, it's points. They're charging you points. It's a yield adjuster. It's profit to the lender so that they can offer a lower rate. So when you're asking for 0 points, if they talk about anything like an origination fee, hang up the phone and call someone who's willing to have a serious conversation with you. Because anyone that's playing games with the conversation of saying, yeah, it's point, idiot. Don't tell me that that's a 0 point. I asked you for a 0-point loan. And I'm not saying that no one should ever charge you points, but they should be honest and tell you this is the 0-point rate. If you would like to buy it down, here's what it is. And here's how long you need that lower interest rate at your loan amount to make it make sense for you.
There you go. We've got Raider Stash asking about a quote here. Josh, obviously we don't have the details, but they've been quoted 5.99% without points, and wondering if it's an opportunity, if there's an opportunity out there to get a better rate with no points. And what I would say is there's a link scrolling the bottom of the screen. Use that, reach out. Josh's team can have some questions for you, and that's probably the best way to get the answer for you. So jebsmith.net/start will get you there. All right, Josh. Have a loan for 160,000 at 7.2 and 772 credit score. Does it make sense to refinance? Again, you're going to need to save probably 3/4 of a point in order for that to make sense based on that formula. It's probably there.
It's really close. Like I would say is, let's have the conversation. Let's run the numbers, and it's within that range.
It's on an investment property.
Forget about it.
Yeah.
Stop having the conversation.
Yeah.
You have, so I will say this, at lower loan to value. So at 160, if that home's worth $400,000 and we got a 40% loan to value, the non-owner hits are much smaller. But if you're at 65, 75% loan to value, you're going to have that non-owner hit, and it's going to push it higher. But I would still say, even with it being non-owner, it's worth having the conversation and setting that strike rate, going through the conversation, having it laid out for you so we can say, this is the number, 5.75 with 0 points, and it makes sense for me. Let me know when it gets there.
Yeah, there you go. Josh, what are your thoughts on interest rates? We did a forecast at the beginning of the year. We set a, my forecast was between 5.75 and 6.75. And I think you were pretty much in line with that. Do you think, knowing what we know now, because we didn't know what we know now then, does that change your forecast at all? Or is your forecast you still think the same?
So could it? It absolutely could. Buying $200 billion of mortgage-backed securities will have a small and transitory impact on interest rates. If you get in a window where rates are lower, great, good for you. And it's possible that decreases spreads, and those spreads stay at those new lower levels, even when that buying backs out. But the real question here, when people are asking this, hey, do you think rates are going to go lower? When we're talking in the scope of refinancing, I guess there are buyers out there who say, I want to wait in case rates go lower in the summer, which is more important to get the right house than to hope and pray that rates go lower. The numbers don't lie. If you can get a low, reasonable cost refinance where you're not paying points and the monthly savings makes sense, I wouldn't risk that waiting for it to get better. We've seen this. I mean, the best example was the fall of 2024, when I had about 10 people tell me, I'm going to wait. I know rates are going lower. The Fed's cutting and they're just going to go a bunch lower. And within 90 days, and it really took a couple days to see 0.25% of that go away. It went away real fast. And it's, for some of those people, it's never come back. We have not, we're sitting here saying rates are at their lowest levels in 3 years. That's based off of either Mortgage News Daily or Optimal Blue Index or Freddie Mac Primary Mortgage Market Survey. I closed some loans at lower rates in like August, September of 2024 than we're at right now. So I'm not quoting the absolute lows of what we've had in the last 2 or 3 years. And some of those people are still sitting there just waiting because they were certain rates were going to go lower. So if we knew for certain that it was going to go lower, like we led off the show, and what was the headline here is that Trump wants to run the economy hot, and there's a good chance he'll succeed. You can hate Trump, but still say there's levers. It could be the absolute wrong thing to do, but there's levers that are fairly easy to pull that will goose the economy here in a midterm election year. And if that's the theory, I don't see rates coming down significantly, even though there's some other tailwinds. We need the unemployment rate to go up. We need inflation to moderate. And then some of these other things that they're wanting to do working, and some of the other things that would sort of stimulate the economy not working in a way that it would offset those things. So I wouldn't roll the dice.
There you go. All right, guys, we've been in 53 minutes. I got about 5-7 minutes left of the show if we have questions. So if you have questions, now's a good time to throw them in because we don't have a lot on the table. We got somebody on Instagram telling us, great topic, keep it up. So Josh, we're clearly doing a great job because we're getting comments over here to the positive. So
That's
good news. But if we don't get comments, we're just going to wrap this thing up, tie a bow on it, and we'll see you next Wednesday. So Let us know. Comments? No comments? Josh, Wing Wednesday tonight?
I am on my own. My wife is going to dinner with a friend. They're having their little girls' holiday dinner. So I'm on my own.
It's not the holidays, Josh.
It's over. They didn't get together during the holidays, so they're doing it now. So I am on my own. So there is a high probability of wings being had this Wednesday.
There you go. That's good news. The good news.
Are you gonna take some wings home to the boys?
I'm not. My wife picked up pokey. Whatever, however you want to pronounce it. So I'm going to eat it, and it's going to be delicious. There's a spot on Main Street downtown, not on Main Street, one of the offshoots down there. Fantastic, from Hawaii, best poke around. So that's what I'm having for dinner, Josh. In fact, I'm salivating as I sit here and talk to you because I'm already thinking about that.
Well, I was going to say the same thing. I'm getting hungry talking about this, but I have like 3 more phone calls before I get to leave. So I'm going to be really hungry after talking about this before I get those calls done and get to go eat.
All right, guys, I'm going to mention this one more time because there's some of you who weren't here, but we are doing our workshop again, January 27th at 5:30 p.m. 5:30 p.m. I think I've been saying 5 this whole time. 5:30 p.m. Pacific Standard Time. It'll be about 90 minutes, last to roughly 7 p.m. It's A to Z, teaching you how to buy a house. The educatedhomebuyer.com/start will get you in touch with the team there and get you signed up. So we would love to see you there. Join, 50, 75, 100 people that'll be on it, and get educated, because that's what it's all about. So got somebody with a $265,000 loan, Josh, 20-year mortgage.
20-year, the term is shorter.
What the rate would be, right?
That's better for you. The rate's going to be better. So that will definitely have a 5 handle on it. Use the link below. Raider Stash says he appreciates the help and honesty. Let us give you the total honesty. Reach out tomorrow, shoot over the interest rate or the mortgage statement. We'll go through the details. We'll get you exactly what you need to know, what that's going to look like.
All right, guys, we'll see you next Wednesday. Adios.
Amigos.